Hi everyone. So we're going to go over break-even analysis. When I try to do this on the board, I always feel like I've run out of room. So I thought it might be useful to use my iPad and kind of go through it that way. So let's see how it goes so that I'm not, you know, running out of room on the board as we go across and erasing things. This way we can kind of evenly transition smoothly through each thing as we go through. So let's talk about break-even analysis. First of all, it's kind of the idea of just calling it a break-even analysis is it's a little bit misleading because you can do so much more. Managerial accountant, and trust me, I'm not a managerial accountant. I, I got a B plus in managerial accounting, but what I do remember is that what's been extremely useful is that break-even analysis. You can really think of it more, at least the name, the way that managerial accountants use it. It's called cost volume profit analysis. And this is pretty useful because it tells you what you can do with this type of analysis. You can understand the varying trade-offs between volume and profit, volume cost, so on and so forth. And it's a very helpful tool because it helps you understand short-term planning and decision making. Again, it's only for the short term. It's not for something that's long term. And there are some limitations to the way that we approach uh, a break-even analysis or CVP analysis because it's based on certain assumptions. And those assumptions are that we will be using a number of different things. We will be using the sales price, variable cost per unit, fixed cost. And when we need to, we'll look at things like targets, like target price, target revenue or target number of units to sell. So all these things in the analysis, they remain constant. So this is an assumption of CVP or break-even analysis. It's looking at the short term. Everything that you're using is not varying. So for instance, because we sell more, the sales price won't drop in our calculations be, so the inputs stay constant throughout the whole process. And when we think about it, we can graph out a break-even analysis like this. So here we'll have our amount in revenue, and here we'll have our units sold. And so we have going up our revenue, then we want to understand our fixed costs. From here, we would draw our total costs, which starts from fixed costs. And then right under that, we can look at this as being our variable cost. And right here, this is our break-even point, which we can calculate in either sales amount or number of units. So let's walk through what we have here. It's important to note that CVP analysis is simple. Selling price, variable cost per unit, and total fixed costs remain constant throughout all of the range. And so let's go through all of the things that go into a break-even analysis. First of all, you have your variable cost. These are the expenses that vary directly with the sales revenue of your business and includes things like rent, utilities, uh, wages, office supplies. These are the things that you incur even if you don't sell anything. So let's go back up here, right here. When we talk about fixed expenses, that's right here. Whereas our variable cost, the expenses that we vary indirectly with the sales volume of the business, those are right here. And all those can add up together to be our total cost. So the break-even point is the point where revenues are sufficient to cover expenses, the point where we neither take a loss or a profit. So right here is where your business starts to look a whole lot more attractive because you are no longer in the negative. And then you can have your target profit. Here's an idea, and this is why I think that cost volume profit analysis is a much more useful descriptive term than break-even analysis. Why don't we try to make a profit? So with this, you can use key data points in the CVP analysis, including selling price, variable cost per unit, total fixed cost, and when needed, you can use the target profit or the target number of units that you want to sell, and you can calculate it that way and add that in to understand what you need to accomplish your goals. So let's go through and do some examples. First of all, let's go over all of the formulas. If we want to understand how we calculate break even, we need to understand what goes into the break even. So these two different formulas are very helpful for understanding the break even in units and the break even in sales. So first of all, we understand our contribution margin. And this is the amount that our sales contribute to the bottom line, especially after we cover our fixed expenses. So our contribution margin can be understood as our fixed costs minus our variable costs per unit. And then we can go even further and we can calculate our contribution margin ratio. With our contribution margin ratio, we're looking at the contribution. Well, here, let's abbreviate it. We're looking at our contribution margin divided by our sales price. So when we look at this, these two go into different types of break-even analyses. If we want to understand our break-even point in units, then we're going to understand our fixed costs divided by our contribution margin. However, if we want to understand our break-even point in sales, then we're going to look at our fixed costs divided by our contribution margin ratio. And then if we want to know the required number of units we need to sell to hit a target level of profit, then we understand this as our fixed costs plus the target divided by our contribution margin. So if we want to understand how much we need to make in a certain profit, we essentially just add the target profit that we set out. If we say that our fixed costs are $100, we want to make a target profit of 1,000, and our contribution margin per item is $2, then essentially to understand what we need to do to make that profit of $1,000 is we need to add 1,100 together, and then we need to divide it by our contribution margin of 2. And you can already see from there that that would equal 550 units to make that profit margin of $100. I mean of $1,000. So let's go through and look at some other concepts that we can learn. You can also look at the profit generated from a target level of units sold, and that is your so so if we have a target number of units, then we calculate that as our contribution margin times our target in units minus our fixed costs. So we can already look at this. So we know that here 550 units gets us a profit of $1,000 right here. So if our target units is $550 and we know that our contribution margin is 2, and we know that our fixed cost is 100, then here you can already see that 1,100 minus 100 equals a target units of 1,000. That a target units of 550 will get us $1,000 in profit. So in addition to that, we could also look at our margin of safety. So when you look at a break-even analysis, your margin of safety is once you clear the break-even point. It's the money or units you can afford to lose before you go in the red. So this way, this right here ends up being your margin of safety. Your margin of safety in terms of sales equals your revenue minus your break even in sales. So let's erase some of this stuff here so that we can kind of go through this real quick. Oh, wow. I need a bigger eraser. Just give it a second there. Okay. So let's go ahead and understand or try to understand our margin of safety in sales. Margin of safety in sales. So here it equals your revenue minus your break-even point in sales. With your margin of safety in units, it equals your target in units minus your break-even point